Right, let's get started. I'm assuming you've all read the risk warning at this point, so let's switch over to the first slide. So the name of this webinar today is different types of stop losses in trading. So as with most of these webinars, be around the 30-minute mark, so hoping to combine some detail and some useful information with brevity, hopefully not going to drag on too long. I also have an uneaten sushi sitting in front of me, so that should encourage me to finish on time here, so hopefully you can all have your lunch break as well. So these are the topics we're discussing today. So just a brief introduction for the beginners out there. What is a stop loss? A little reminder for everyone, why would we use it? What are the benefits of it? Combining stop loss and position size touches on some of the kind of risk management themes that we discussed in last week's webinar. If you didn't get a chance to watch that, it's on YouTube. Fixed, so then we're going to go through the three main types of stop loss, which are offered by LCG. So the fixed, sort of basic stop loss, guaranteed stop loss, which often has a few questions surrounding it, and trailing stops, which can be an interesting quirk on how to not only manage your losses but also manage your profits. And then we'll dig into a bit at the end about where to place a stop loss and some of the kind of typical techniques that I and many others use for trading. If you have any questions at any time, just feel free to pop them in the box. I'll answer them as soon as I can. So what is a stop loss? It's a type of stop order. So just to differentiate, it's not a limit order or a market order. So the way I was always taught to think of this is that a stop order is at a price that is worse than the current market price. So if you're buying, you'd place a buy order for gold, and your order to sell, which is to cut your losses, is at a lower price. So obviously, if you think about it, it's a sell. What you're doing here is you bought something and then you're going to sell it afterwards, right? If you're selling it at a lower price than you bought it, that's worse, right? So that stop order in the case of buying would be below the current market price. Sorry, in the case of selling it would be below the current, because obviously you want to sell at the highest possible price, right? Equally with buying, you want to buy at the lowest possible price. So the best price for buying is below the current market price. So that's why when you have a buy stop order, which is obviously a different type of stop order, not a stop loss, a buy stop will always be above the market price because that's a worse price than you're currently getting. A buy limit order will be below the current market price because that's a worse price. So I hope that explanation has cleared things up rather than confuse things. But I think you get it. And obviously, if you don't, let me know. I'll happily re-explain it. So then specifically, so we know a stop loss is a type of stop order. It's not a limit or a market order. The way a stop loss order works is that it's basically an instruction that you're giving the trading system to automatically close a position, which is obviously an open trade, at a loss when a specific price is reached. So then what happens when that price level is reached? A trade will be entered at the next available market price. So it's kind of like the market drops through this price that you've specified. That causes you a loss. As it goes through that price, it may be that the next available price is the exact stop loss that you've specified, or if there's some more volatility in the market, which we'll discuss in a minute, some different scenarios like gaps and things, then it will be the next available market price. So sometimes that next available price will actually be better than you anticipated, and then other times it will be worse. And then this little box that I've got at the bottom here, just a basic little explanation. If you're going long, you're buying, you're opening your position with a buy, your stop loss is going to be below the current price. Shorting obviously means you're selling the market, so you open your position with a sell. So your stop loss is above the current price, and it's a buy order. So why use a stop loss? Two reasons really: to control and minimize losses and to lock in profits. So a stop loss is absolutely key to controlling your downside in trading. I've been trading a number of years and I still use an actual stop loss order in the system. A lot of people who've been trading for a while choose to use more like a mental stop. I know I want to get out the market at this price. For me, it just adds a little bit of discipline if I actually put the order in place. But that's a personal preference. The idea is to know when you want to get out the trade at a loss. The general thought process there being that when a trade does go wrong, and they will go wrong sometimes obviously, you've just got to stop the losses to keep enough money in your account so you can place some other winning trades. So you don't want all your money going towards the loss, right? You want to cut the loss and move on and put your money to better use in a profitable winning trade. Equally, when a trade has made some profit, you may want to protect that profit. Markets don't go continually in one direction. You may have caught one leg of the move correctly, but you don't want the market to completely retrace all your profits. So a stop loss can protect some of the profit. We can talk about some of the specifics on how, but you could move a fixed stop loss, or you could use a trading stop loss, for example. Now, this is something I often hear about as a reason for people not to use a stop loss, and I just think it just couldn't be more wrong. So the ultimate argument is, oh, I don't want to use a stop loss because whenever I do, the market comes down, hits my stop, and then reverses and goes in the direction I originally planned. Well, of course it will. Of course the market goes up and down. Most of the time the markets are in a kind of range-bound environment. You'd say range-bound environment 70% of the time, trending 30% of the time. So oftentimes the market will just come back. That's not a reason still not to control your losses. Number one reason arguing against that is that there are occasions when the market won't turn. It will start horrendously trending against you. For example, if you were recently long indices like Wall Street, it had been a prolonged period of the market moving higher. Over the space of 2-3 days, the market gave up about 10% of its overall value. So you do get these sudden bursts of trending periods that go against your position, and it only takes one of those, I was going to say one or two, but really only one, to wipe out your account and undo all the good work that you've done on all the smaller profits you've been making on the way up. So stop loss is really all about that risk management, keeping you in the game with small losses and avoiding those big catastrophic losses that are very hard to bounce back from, both mathematically and emotionally. And then the number two reason I would say is that argues against, why the market comes down, hits my stop loss and always goes back again, is that probably the issue is not that you're using a stop loss. The problem is more likely that your entry was a bit impatient, so i.e. a bit early. So if your entry is a bit early and you're buying the market, for example, it may be that your stop loss has to be that much higher because your entry was that much higher. So you should have waited for the market to pull back a bit further, or you should have waited for a stronger confirmation of the breakout so that your stop loss didn't need to be so tight to the market. And that fits in with the next point, is that maybe your stop loss is just too tight. These are volatile markets that LCG offers. That's what makes them good for trading, but the price will swing around. So you can't have the stop loss so tight that you don't give the market any breathing room. That will often be a cause of why your stop's getting hit and then going off, is purely that you need to work on your entries and exits rather than actually whether to have a stop loss or not. So I hope that makes sense. We covered this in the other webinar, so I'm not going to go over it in too much detail, but the general idea here, same idea in terms of risk management, is that you only really want to risk 2% of your capital on any one trade. So then how does that translate in terms of stop losses? Well, for example, if you have a $50,000 account, a stop loss of $1,000, which is 2% of that, shouldn't throw you off. It's about appropriate for you to be risking $1,000 if you have $50,000 to risk per trade. Because as I said, $1,000, you've got 49,000 left. You've got plenty of room for trading. A stop loss of $10,000, you still do have $40,000 left in your account, but that's 20% less than you did previously, and it then takes much more than 20% just to even get you back to break even. And so that's emotionally and, as I said, mathematically harder to bounce back from. Of course, when you get the winners, they'll be proportionally bigger, but we have to think about the downside in these markets too. And something I mentioned last time is some people will vary that per trade, sometimes 1%, sometimes 0.5%, sometimes 2%. For me personally, I tend to stick with 2% because it makes every trade that you take have a kind of equal impact on your trading account in terms of potential for loss and also profit potential. So let's talk specifically about just the kind of classic, basic, fixed stop loss. And so I'm going to bring in the trading platform a little bit here as well, just to explain how this fits together on the LCG Trader. But in essence, the fixed stop loss is placed a fixed number of points or currency amount, so you can set it in pounds or dollars, for example, away from your entry price. So you're just fixing it at, you enter here. If you're buying here, price drops. You're going to get out the price at exactly this price point or exactly this amount of pounds and cents lost. So the fixed stop loss does not move, but you can modify it. So you can move it up or down. There is a minimum points distance for a stop loss, and it's normally just a bit more than the spread, normally 1 or 2 points, nothing too dramatic. But it's almost for sort of practical purposes. There's literally no point in having a stop loss like less than the spread, for example. You're just going to be hit out of trades the whole time. I don't know the actual reason. I'm sure there are some practical, technical reasons for having a couple of points minimum distance, but I think it's almost saving traders from themselves because there's really no point in a 2-pip stop loss. It's almost just, that's just 50-50 whether that gets hit or not. So a fixed stop can be added at the start of the trade, added later, or be removed. So yeah, let's flip over to the trading platform here. Hopefully I can successfully do this operation. No, I can't. Oh, classic. Okay, it's going to have to be not as smooth as I'd hoped. There we go. So here we are, LCG Trader platform. I've got the UK 100 on there at the moment. Happen to be buying some Wall Street. But let's place a new trade. So let's say maybe we've had a breakout here. Potentially it's reversing, but who knows? Like maybe a little breakout through these highs. Maybe we're just getting a little tracement and then the market moves higher. Let's see, who knows? But let's place an order to buy the UK 100. So the choices here is if you just click this buy button, you just jump straight into the market with just the entry order and nothing else. So if you want the order ticket, you'd click on this little create new order icon on the side. And so we're deciding we want to buy some UK 100, right? So maybe we want 0.1 lots. Let's say I'm in the CFD trading platform, in case you're wondering. And so then we want to add a stop loss. So you can see that if I go, for example, -1, it gives you a little warning. Minimum distance for stop loss is -2. So it's also highlighted red. If you try and go below the minimum distance, it's all quite simple enough. You're not going to be surprised. You're not going to think you've placed the order and actually you haven't or anything like that. So say we want to do a stop loss of -20. Oh, I've already done the one. -20. Because yeah, it's a very small percentage of our account and it adds up to about $27. So I've set the number of points I'm happy to risk here. Equally, I could have decided it's a certain price level, so maybe it's 7225, for example, is the exact price I'd want to cut my losses at, and that just adjusts those number of points accordingly. So you see that's moving up and down because obviously the entry price is moving, the current market price rather is moving up and down. So obviously the points away that it is from that level is varying. So then I would go ahead and place that order. That's clicking that shows that I want to be buying, and then I place the order. And it gives you confirmation right there. So, So I hope that's all clear enough. Obviously, if you have any questions, again, let me know. Guaranteed stop loss. Works the same way as a fixed stop loss. So it's doing exactly the same thing. It's a certain number of points or a certain price level below if you're buying, above if you're selling. The big difference here is that it's guaranteed to execute at the exact price that you set it. So as I mentioned before, a normal stop loss will execute at the next available market price. So sometimes there just won't be a market being made at the price you've specified. So there can just be slippage. So your order goes through, but by the time the market order comes to take place, the market's already moved to a different price. That's just all part and parcel of trading. You do tend to get a bit of slippage. Not so much with LCG because we do work with all the top liquidity providers, but certainly still a factor. And then you have gap risk. So particularly if you've got, placed a stop loss and then there's some dramatic news event, maybe the price will just jump straight through your stop where your stop was placed, and there won't even be any trades taking place at your stop price. So the market will be readjusted to wherever it has after the news event, and then your trade will get triggered. So if you want to avoid the risk of that happening, you have the option basically of paying to guarantee your stop loss at a certain level. So we'll go ahead and do an example of this in the LCG Trader platform, and you'll see that the charge is typically 3 points, and it comes up as a withdrawal under your transactions tab. So, oh dear, look at that. Looks like a false breakout at the moment. Maybe we'll be okay. Obviously coming off that other resistance, still in a downtrend maybe. Who knows? So let's place a new trade. Maybe we'll have some better luck with maybe Wall Street, and we've already got a trade on there. So maybe let's switch to pound yen for some reason I have up here. If I just switch the template, looks a bit visually easier here. So a bit of a bounce off the lows. Maybe we're going to get a little reversal here. Again, I've not planned this trade at all, but let's do a little pound yen trade. So I can right click on the chart. There's a different way of starting a trade. Click new order. So we're in CFDs here. So I'll buy maybe 1,000 pound yen, 1,000 the pound yen pair. Let's see. Do I want to do 1,000 pounds? Maybe I'll do 5,000. Or 50,000, hold on, 5,000. Add a stop loss, same exact thing. You can set the number of points or the specific price amount. So what should we go for? Maybe we'll give ourselves about 50 pips of leeway, 25 pips of leeway. Yen. Hold on, what am I doing wrong here? Buy, turn is stop. While I'm at it, I'm going to mention this little arrow here in case anyone's wondering. So basically, you've got some optionality here next to the stop loss. So this is one of the most common reasons that people call in for is, hey, I got stopped out of my trade, but I'm looking at the chart and it never got there. Well, the point is that the chart is based on the bid price. So depending on whether it's a sell or a buy order, that your stop loss is. So obviously if you're buying, your stop loss is going to be a sell. A sell will take place at the bid price. A buy, if you're shorting the market, will take place at the ask price. So the point being that the chart is based on the bid price. So if your order is based on the ask price, then it may be that the ask price hit, so the difference in the spread of 2-3 points, whatever it is, the ask price may have hit your stop and triggered your stop loss order because it was a buy order. In the case of selling for a short trade and a stop loss being a buy order, and so that the chart won't look like it's hit it, but actually it has. So you can actually swap that around. So you can just say actually the stop loss will be triggered by the bid for buy positions instead of the ask. So you can kind of switch it around depending which way the arrow is facing. And then you can. This is a really nice option that I wasn't even aware of until recently, the LCG offers. But basically the idea being, it doesn't explain it well in this little box. It just says the same thing. But the 2 arrows means that, sometimes, like I was saying, well, okay, the market spikes down, hits your stop, and then reverses and goes off in the other direction. The 2 arrows means if it is just purely a spike that comes down and just kisses your stop loss and then bounces straight back again, it won't initiate your stop on the first. You won't get stopped out on the first time it hits it. You will only get stopped if it comes back down for a second touch. So if your stop just gets touched, market bounces, never comes back, you'll still be in your trade if you have these 2 arrows selected. So that's a really nice feature, and it doesn't cost you anything extra to do that, which is actually very, very useful. Now, I don't know what I've done here, pound yen, but for some reason, maybe the guaranteed stop's not available in pound yen because it's a volatile market. That seems surprising, but let's try gold. Create new order. Go for 0.1 lot, stop loss. Okay, so it's a little example that I unintentionally demonstrated there. That maybe, I think the reason being that it's a more volatile currency pair is that a guaranteed stop loss was in fact not available on pound yen. But here you can see in gold it is. So here you can see that it says extra spread. This is a little bit confusing, to be quite honest with you. It's not adding to the spread. It is 0.404 points, but it's added as a separate transaction. We'll see that in just a minute. So then you can see here that the minimum maximum price for a stop loss is that, but it may be even more. So am I buying here? Yes. Let's see, if I go down to 17, okay, that's acceptable. So basically the idea was that I wanted to show you what the minimum guaranteed stop loss distance was. If I just X out of this again for a second, and we go over to gold, and I go information, this will mostly tell you all you need to know. Min guaranteed stop loss distance in points, only 2. Yeah, so it's actually very, very competitive in gold. In some markets it's a bit wider, but you don't really have to do too much at all to put in a stop loss here in gold. So there you have it. Close it down again. Let's go back to our deal ticket. Buy in gold. 0.1 lots is fine. Guaranteed stop loss. So we obviously haven't got far away at the moment, but if we say 25, how's it like that? Yep, that's over the 2 points it needs that we just saw. So let's place this order buying some gold. Okay, so you can see down here that it's got GS. This is in your positions tab down here, and you can get to this by modifying the layout. So you may have just a chart layout, you may have the watch lists on the side, and then if you just click it again, brings up your sort of trade management area down here. Guaranteed stop. So then if we switch over to transactions, you can see a withdrawal of minus 0.4, the guaranteed stop loss charge for that position. So we had a pretty minuscule position on gold, so it's only charged us 4 cents. Obviously, the bigger position, the bigger proportional amount your stop loss size is going to be. So when it said under the info, if we go back to it again, distance 2 points, it's basically what you're doing is 2 times the kind of calculation that you're doing here is 2 times your lot size, and in this case it's in dollars. So then you would just be translating it back to pounds, for example, if you had a pound-based account. Actually, as it happens, I think I've got a USD account, so it's all simple enough here. So there we go. Interesting question from Comrade just about a guaranteed entry. No, there isn't anything like that actually. Yeah, no guaranteed entry order. The only 2 entry options that you really have are, well, obviously the most guaranteed entry price is if you just place a market order. Obviously, it will just enter you straight away. Or you can place a stop order. A stop order may not get triggered if there's not if the market spikes through it and then comes back very quickly. Now that can happen. With a limit order, when you're buying below the current market price, if the market does touch that level, you should be in at the limit price rather than the next available market price. You should be in at the limit price. So in a sense, that's achieving the same kind of thing. Limit orders don't quite work in the same way as stop orders. You get in either at the limit price if it's available, or just nothing at all. So even if the market tanks straight through your limit, you'll get either your limit price or a better price, because the market have tanked down. You'll enter in at a lower price to buy, for example, which would be better. So in essence, a limit order sort of does fit the bill, if you know what I mean. You're not guaranteed to get filled, but if you are, it's at the price you want or better. Cool. So what else was going to look at here? Oh yeah, so it's just going to maybe modify. So if you right-click modify, you can also click one of these icons on the side, modify position, and oh, this is actually my trailing stop, which I was going to do next. So say we didn't want it to be guaranteed anymore, we can turn the guaranteed stop off, but you don't get your money back, unfortunately. So there's 2 things to bear in mind about the guaranteed stop. Is you can only place it at the beginning of the trade. So for example, on, I thought this is UK 100, open position, right? Modify it. You can see that I can add a trailing stop, but guaranteed stop is grayed out. So you can't just, so idea being that the market's like suddenly plummeting. You didn't want to pay for a guaranteed stop loss when you enter the trade, but suddenly it's looking a bit like your stop might get hit. So you chuck in, okay, now I'm happy to pay 3 points for a guaranteed stop. Well, obviously that's kind of open to abuse, if you like. So that's not allowed. Let's see, let's try and flip back. I think we've covered the minimum point distances, we understood the fee, I think, and we've talked about it, you can only place it at the start of the trade. So I think that's all good, guaranteed stop loss. Good to know about, right? It's obviously a trade-off. You pay for the privilege of it, but when we're in volatile market conditions, you're obviously adding a little bit of a safety net. More of a safety net than a normal stop loss, you might say. So a trailing stop loss starts off just the same way, and it's the whole purpose of it. It's pretty much the same, of controlling your losses when the market moves against you. But what's different about it is it trails the market as your trade makes a profit. So if you're buying this trailing stop, as we see in this example here, the market's moved higher, you may be bought down here, for example, maybe your stop loss was originally under this swing low or further down maybe. As your trade moves into a profit, this stop loss level moves up with it. So the idea there being that it's a way for you to lock in some of your profits in an automated way. So as I mentioned before, you can always modify your own fixed stop loss. So you can always just trail your own stop loss up the market, maybe behind the daily candle close, something like that. But this adds a kind of automated element to it, so that you go to sleep at night in a forex trade. The market suddenly goes right against you when you were in a profit. Well, you've locked in a bit of money. So yeah, just to reiterate, as the price moves in your favor, the stop loss trails your order. Key thing to note here, though, that if the price moves against you, the trailing stop does not move. So it's not like if this market here starts rolling over, this stop loss starts moving back again. It just stays there. So then if the market keeps going, it stops you out. So obviously serving its purpose of controlling your losses. If it just continuously moved down with the market, there'd be no point, right? It would never get hit. So that's why. I was told a weird example, a weird way of understanding these trailing stops is, imagine yourself walking up a staircase and you've got a chain attached to your foot with like a bowling ball on the other end. You're dragging it up the stairs, and every time you take a step, the ball gets dragged up an extra step. But then if you turn around and start walking down the stairs again, the ball's not going to move, right? It's just going to stay on the same step. Basically the same idea with this trailing stop loss. Weird example, but it kind of works. So the minimum distance for a trailing stop is about the same as for the fixed points. I think it tends to be a little bit more. I'm not sure there's a rule of thumb here. Again, you can check, and it will tell you when you're placing it as well, but it's normally 1 or 2 points, not normally a big barrier to entry. A fixed stop can be converted into a trailing stop, and a trailing stop can be converted into a fixed stop. So you can modify your order as you go, which adds a good amount of flexibility to things. So maybe you start with a fixed stop, for example, then the trade moves nicely in your favor, it looks like a trend's breaking out, you turn it into a trailing stop. And the nice thing about a trailing stop, a bit more flexibility than the guaranteed stop. You can add it after you place the trade, just like a classic stop. So you could jump in the market quickly, and later on, once you know that you've got a position on, you know you're there to take advantage of any price moves taking place, and then you can go in and set up your risk management, set up your orders, your stop loss, and your take profit example. So so you can see I've got actually an open position here in Wall Street. That's a TS is for trailing stop. But let's just do a new order here for the sake of it. Dare I do an order in Bitcoin? Let's see. Let's do it. So if I go to the tab here, stop loss. Yeah, we're all happy with that. And then we've got 168 points set as our stop loss. I'm not sure how that defaults. I'm not sure what the justification for the default amount is. I think it might actually be changeable in settings somewhere. I'm not going to go into that, but worth investigating if you're interested. I think you can change in the settings what the default number of points is. Obviously, it's going to vary to some extent for different markets. But say we're happy with 200 points, click trailing stop, and then we're buying the market, place. So, okay, I don't think I actually have a chart for that open, so let's have a look. BTC, USD. So there you go. So you can see, if we zoom in on this market a little bit, there's my order. Did I sell in the end? To trading stop? No. So there's my order to enter the market. So I was buying at 1138. So that's buying the market up here. And here's my trailing stop down here. And you see it says TS 10953. And so the idea being that, hold on, is 10953. Oh, so there it is. I was thrown off by the bid price there. So obviously we're buying at the ask price, right, which is this blue line up here. The red line here is the bid price. So that would be the price we would be selling at, right? So we bought the market up here, and you can see a nice example of how it's the bid price, right, which the candles are made of. And then you can see it's a bit faint, but if I zoom in a bit, you can see this little line down here, which is actually clear enough on the left-hand side. That's our TSL trailing stop loss. And so the idea being that, the market's moving up a bit, you should have been able to see there, and I think it actually adjusts here, that your stop loss amount will move up slightly with the market. Yeah, so you can see that. So pretty much every time the market moves higher by 1 point, your stop loss should trail up with it. So point by point. So I hope that was clear enough. And then, as I said, if we wanted to modify it and make it not a trailing stop anymore, change protection. It's still a stop loss in the same position down here, but it's just not a trailing stop anymore. Oh, maybe we want to make it a trailing stop again. Modify position, make it a trailing stop again. Change protection. Doesn't cost you anything extra. You're just modifying how you're managing the trade. I have gone over the half an hour mark, haven't I, Michelle? And I promised not to. This will be available as a recording afterwards. Yes, feel free to keep watching the remaining after lunch later in the day. Thanks very much for coming, and apologies to anyone who has to go because I'm running over. So this is kind of the last, but we've basically explained all about stop losses at this point, what they are. This is just kind of the final bit. It's where to place the stop loss. Simple answer being that you set the stop loss at a price level that, if reached, offers you sufficient proof that the trade was wrong. Not that it's wrong, if you're following your system, it was right of you to place the trade, but sufficient proof that it's not going to work out, basically. It's probably going to end up not going to plan, if you like. So, okay, that's a very general statement, obviously, and I'll dig into some more specifics in a minute. But I want to go over some of the common mistakes when placing a stop order. Obvious one, number one, just not planning one, or just not using them at all. Not using them at all, obviously, hopefully this webinar will change that particular habit. But not planning it, that sort of opens yourself up to making decisions while the trade is still open. And, that opens you up to sort of emotional based decisions, which tend not to be as good as in the cold light of day before you actually place the trade. Common mistake number two, similar idea really, is that you're changing the stop loss within the trade. So the classic is obviously, oh no, the market's coming down towards my stop, let me move it wider. You're not going to learn anything from your original trading plan, and whether it's a successful plan or not that works over the course of 20 trades if you just modify it all the time, because there's not really any system that you can judge whether it's right or wrong. You need to place your entry, place your stop loss, place your target entry, or use a trailing stop to take you out of the market, and ideally just leave it, because then you can judge, over the course of 10 or 20 trades whether what you're doing makes sense or not. If you're just changing it all the time mid-trade, what is there to judge? There isn't any kind of system behind it. But that's why I say unplanned changes. Obviously, if you do have a specific plan to trail your stop loss, then that's something different. I would almost never recommend widening your stop loss beyond what's planned. Possibly an exception is if you know that there's a news release happening and could cause some kind of unusual price movement, but even then, I don't do it. So common mistake number 3, setting a stop loss based solely on risk tolerance. So we talked before about having that 50 grand account and you're willing to risk 1 grand on a trade. I mean, that's all well and good, but don't just randomly set your stop loss at £1,000 based on any kind of random size trade, and the stop loss just happens to fall wherever it does based on £1,000, because at the end of the day, the market doesn't know or care whether you've had a 2% drawdown in your account or not. You've got to set the stop loss based on some specific market phenomenon, and we're going to have a look a bit at what those might be on the next slide. So the long answer is there are lots of ways to place your stop loss. Not too helpful, right? But the best thing to do, as I said before, is to practice and review different methods to see which are working best for you. And that's just the ultimate rule in improving your trading techniques, is to practice and go back and review what you've done and have a think about what you could have done differently and whether that might be worth changing to or keeping as you are. So we're going to jump back to the LCG trader in a sec, just to look through some of the kind of common techniques as to where you might put your stop loss. So for me, more often than not, it's based on support and resistance levels. Round numbers form a part of that. A lot of people are big users of trend lines and also moving averages in both of those last two, particularly in trending markets, obviously. So let's have a look here. So an example might be dollar yen's a bit of a crazy looking mark. Well, let's if we go down to 4-hour chart. So say, for example, we had a big drop in the market, and you're waiting for the next leg down. So we have a bit of a sideways movement here. So either you've used a trend line, for example, and so we've had a little bump up here, and you decide to place your entry order when the market takes out these lows here. It breaks a trend line, then takes out the lows, opens a new candle down here, and you decide to short the market. Well, if you consider this level up here to be the resistance, then it would be your stop loss would be placed up above the high up here. Now, in the case of a breakout trade, you're typically trading pretty low down, obviously. You're kind of selling low in the hope of buying it back even lower, right? Rather than selling high and buying low, if you like. So that's quite a wide stop loss. It's the safest stop loss, but it's quite wide. An alternative would be that you've got this trend line as your was support. See, by this candle we tried to bounce up, we got up to the highs, reversed, and the support gave way. The support typically turns into resistance, so what we could then do is decide to put a tighter stop loss just above that trend line break. That might be another way of doing it. Let's look at the same scenario. Another possibility is that you've seen this big leg down, the market's bounced up a bit, and you're looking for some level that you think this bounce might end, or maybe even it's rolled over once, you're waiting for another bounce before it then continues to cascade lower. What you can use is, for example, this is more like a kind of swing trading technique where I get rid of most of these and try and make it a little bit clearer. You can apply that as a default setting. I don't really like that purple. Let's make it, there we go. So again, obviously, I'm really not really, there's obviously a benefit of hindsight, right, with these trades, but say we had that down drop, we're waiting for some kind of pullback of that drop before expecting the market to roll over again. So basically we got to this kind of sweet spot between 61.8 and the 78.6% Fibonacci's, and then we saw the market start to roll over. So maybe our entry is somewhere around here. Now we've got a choice. We could wait for some kind of confirmation and have a kind of lower entry down here and then have our stop loss above this high, or we could just have an order right at the 61.8, for example, without any confirmation, and then maybe our stop loss is above this high up here. So if I remove the fibs, you can start to see this is with the potential stop loss above here, and this is our perfectly timed, with the benefit of hindsight, entry. And then maybe we take our profit at the lows down here, or maybe some Fibonacci extension of the lows down somewhere down here. Two examples of just using trend lines and support and resistance there. What else did I mention? Moving averages and round numbers. Well, round numbers often play into this because you notice at 11, 12, right? Maybe we see the drop. We think this big decline is going to continue. Waiting for a little pullback. We just sell. I don't know why it's done some weird thing there. Snap to chart prices, that's why. Turn that off. Basically you're not going for the perfect entry here, but you're just of the logic that, well, if it doesn't sell off at 1100, maybe I'll have another crack at it at when it gets to 1150, which just, as you can see, happens to be almost perfectly the high here. So these round numbers are an absolute feature in these markets. So you can see that on this first bounce we've got to 1150. You're maybe thinking we dropped a bit. Maybe we don't get much beyond 1100 this time. So you just sell at the 1100 mark, have your stop loss up at the other round number 1150, and then again, not a precise entry point, but you're going in the right direction of the market. You're using a round number which institutions pay attention to, and in this perfect hypothetical example, the market continues on in your favor. And then you can see down here it's actually 110.20, which is the low here, but if we could just modify it to being 110 as a target, or we could just target the next level down, 109. You can see the market reacted from that 109, or maybe if we timed it perfectly, see the market didn't quite get to 108, maybe 108.50. Actually, you can see pretty nicely here it was 108.50. That's turned into the support, right? And last but not least, you can obviously institute some sort of moving average into this. So if I say indicators, trend, simple moving average, maybe let's see what's working here, 20 perhaps. Obviously some simple examples of here, maybe in this particular section of the trade, or even just the bit we've been dealing with, while the market's below the 20 period moving average, you just let your position ride. Here it touches the 20 moving average, but then down here it spikes above it. So you might just be using the period moving average as a basis for your stop loss. So you entered the trade up here somewhere, drops through the moving average, just about survives it there, and then you get stopped out here. So that that's not a perfect science, but it's it can generally kind of keeps you on the right side of the trend when you use some form of moving average. So that's about it. So yep, I did go over, went way over in the end. Dear oh dear, bad timing, but hopefully the information was useful. And if you did have to log out quickly today, this will be available on YouTube in the next few hours. Good luck with trading, everyone. Hope that was useful, and much appreciated for attending today. Good luck with trading for the rest of the week. Just signing out.